Hey traders, in this video we're going to dive deep into one of the most powerful tools in trading, the Fibonacci retracement. I'll show you how to use it for both continuation and reversal setups, step by step, with examples, psychology, and strategies you can start applying right away. By the end of this video, you'll know exactly how to combine Fibonacci with price action to improve your entries, exits, and overall trading confidence. So if you're ready to take your trading knowledge to the next level, stay with me till the end. And if you're new here, don't forget to subscribe and hit the like button to support the channel. Let's start with the basics of market structure, because without understanding how price moves, Fibonacci levels won't make much sense. In every financial market, whether it's Forex, crypto, gold, or stocks, price tends to move in waves. We see impulses and corrections, rallies and pullbacks. When buyers are stronger, price pushes higher, creating an uptrend with higher highs and higher lows. When sellers dominate, the market moves lower with lower highs and lower lows. And when both sides are equally matched, we get sideways or ranging markets, where price keeps bouncing between support and resistance. There's also a fourth type of condition, the choppy market. In this phase, price whipsaws back and forth with no clear direction. Buyers and sellers constantly take control from each other, leading to messy moves, false breakouts, and unpredictable swings. This is usually the worst market condition to trade, so it's better to step aside until a clearer trend forms. Now let's focus on trending markets, because that's where Fibonacci really shines. The key question every trader asks is, when will the pullback end and the trend continue? Or, is this the start of a possible reversal? That's where Fibonacci retracement levels give us an edge. The Fibonacci concept is simple but effective. When you measure an impulsive move with the Fibonacci tool, certain retracement levels often act as strong support or resistance. These are the 38.2%, 50%, 61.8%, and 78.6% levels. When price pulls back into these areas, it often reacts, either continuing in the same direction or reversing. Let's break it down step by step. Imagine price just made a strong bullish impulse. You take your Fibonacci tool, anchor it at the bottom of the move, and drag it to the top. Now the retracement levels appear on your chart. When price starts pulling back, you'll notice that it often pauses, rejects, or reverses around one of these levels. Small pullbacks, usually to the 38.2 or 50% level, indicate a strong trend. Deep pullbacks to 61.8 or 78.6 suggest weakening momentum and the possibility of a reversal. If the pullback doesn't even reach 38.2%, we don't really count it as a proper correction. Instead, we treat the entire movement as one single leg. Now that you understand the basics, let's get into the strategies. The first strategy is a continuation setup. This works best in markets with strong, clear trends. The idea is to catch a pullback to the 78.6% level and ride it back to the swing high. Here's how you set it up. First, identify the latest impulsive move in the direction of the trend. Apply the Fibonacci tool from the start of the impulse to the end. Next, place a buy limit order at the 78.6% retracement level. Your stop loss goes just below the swing low, and your target is the swing high. This setup works because in an uptrend, the probability of price retesting the high is greater than breaking the swing low. Even if the market is losing momentum, it usually attempts to retest the previous high before reversing. And because of the placement of the stop loss and target, this trade often gives you a risk to reward ratio of about 1 to 3. The strengths of this strategy are its simplicity, its high risk to reward ratio, and its trend-following nature. The downside is that in strong trends where pullbacks are shallow, you might miss trades because price doesn't always come back to the 78.6 level. Now let's move on to reversal setups using Fibonacci retracement. This is where things get even more interesting. When a trend starts to weaken, price often creates patterns like double tops, double bottoms, or strong rejection candles around major Fibonacci levels. By combining these signals, you can catch early reversals. For example, imagine price is in an uptrend and then pulls back to the 61.8 or 78.6 level, but forms a double top pattern with strong bearish candles. This is a clear signal that buyers are losing strength and sellers are stepping in. By entering here, you're catching the start of a potential downtrend. The psychology behind this is simple. Traders and institutions watch these Fibonacci levels. When price reaches them, many orders are triggered. If the dominant side fails to push further, the opposite side gains momentum and a reversal happens. Another important concept is multiple timeframe analysis. Fibonacci works best when you align it across different charts. For example, if you're trading on the 1-hour chart, also check the 4-hour or daily chart. If Fibonacci levels from higher time frames line up with levels on your trading chart, those zones become much stronger. This is called confluence, and it's one of the most powerful edges you can have. Now, how do you manage entries and exits with Fibonacci? For continuation trades, you usually enter with limit orders at the retracement levels. For reversal trades, it's better to wait for confirmation, such as a candlestick rejection, a pattern like a head and shoulders, or a break of structure. Stops should always go beyond the swing point to avoid being taken out by market noise. Targets can be the swing high or low, or the next major Fibonacci extension level, such as 127.2 or 161.8%. Let's summarize the key setups before we wrap this up. For continuation trades, focus on deep pullbacks to 61.8 and 78.6% levels, place limit orders, and target the swing high or low. For reversal trades, look for double tops, double bottoms, and rejection candles around Fibonacci zones, and combine that with confirmation from multiple time frames. Final thoughts. So traders, you can clearly see that both continuation setups and reversal setups work beautifully with Fibonacci retracements. The main thing to remember is this: continuations are all about following the trend. You wait for price to pull back to deep Fibonacci levels like 61.8 or 78.6, then ride the move back to the swing high or swing low. Reversals, on the other hand, are about spotting when the trend is losing strength. By combining Fibonacci levels with patterns like double tops, double bottoms, or strong rejection candles, you can catch those powerful turning points. In short, Fibonacci retracement is not just a random tool, it's a way of reading market psychology. Traders, investors, and even institutions watch these levels, which makes them powerful reaction zones. If you master this and apply it with discipline, you'll always know whether to ride with the trend or prepare for a potential reversal. So that's it for today's video. I hope this lesson gave you real value and a clear understanding of how to use Fibonacci retracement in your trading. If it did, make sure to hit the like button and subscribe for more trading strategies and breakdowns. Thanks for watching, and I'll see you in the next episode.